On your show last year, even though silver was my largest holding, physical silver and SLV or any of the ETFs out there, um, you know, we never talked about it breaking 30 ever. We, in fact, said it wouldn't break 30, but we were going to be patient. So we added to silver last year 5 times, from 23 an ounce all the way to 30 when it broke out, right? And then we stopped adding to it. We're just riding it now because it's a 10% weighting in our portfolio. That's a lot. So yeah, I have every incentive to tell you silver's going to 100. I'm not going to say that. I think at 41, you've got some resistance between 42 and 43. We keep knocking on that, and it's sort of just fluctuating right now. We have to get through that level. But honestly, after that, it's all the way to 50. What Don Durrett and I talk about, though, is that 50 is not really the target here. 50 is an old target, given that you have to inflation adjust, and that would get you closer to 68 to 70 an ounce. I would say we're not in the early stages. I mean, gold, if you look at GLD, for those that want to look at a chart, has been ripping for months and months, right? Like September 2022 was the low for GDXJ, and gold was probably 1600-ish then. I mean, like, it's doubled since then. So anytime a commodity doubles, you have to look at the RSI, the relative strength index. You have to do these kind of things, different metrics to make sure and check your thesis. We do this in a bull run like this. I'm doing this every day. I'm not kidding. Like, I'm not like taking one day off from checking myself. And, I sold something yesterday with an RSI of 84. Like, once you get above 70, it's sort of like you start thinking about selling. Then 75 to 80 in a rally is sort of there. I mean, just to give your listeners some perspective, when we went on camera, the RSI is at 76 on gold. So like, it's already elevated, but it's elevated for a reason. The US economy is starting to turn over, and we can talk about that as we move forward. But, keeping on gold, look, I mean, a lot of the banks have acquiesced, right? They started to do this first quarter of this year, 33,000, 3,200, 3,500 targets. Now those targets are more like 3,500 to 4,200. And sitting here, let's say at a round number of 3,600, you've got a lot of upside to 4,200. I don't even know what $600 in gold means to most of the gold stocks I own, but it means very good things.
Momentum indicators are flashing caution even as enthusiasm builds. Gold's Relative Strength Index, RSI, has climbed into the mid-70s, signaling elevated conditions. Traders know that above 70 often suggests overheating. Yet bull markets can stay overbought for months when conditions align. Many investors are now rebalancing, trimming at extremes while staying positioned for the bigger move. History shows that gold doesn't always need explosive Fed cuts or crises to rally. Steady uncertainty can be just as powerful. The lesson? Technicals can guide timing, but fundamentals ultimately drive the trend. Gold's strength is less a spike and more a structural revaluation.
Look, I hope I'm wrong. I always say that because I want the 4,000 target. I want the 5,000 target. We had 3 targets this year at 3,200, 3,500, and 3,800. We missed our target last year by $8. So we're pretty down the middle as far as our estimates go. We don't try to be sensational because I think the targets we hit this year are fantastic, right? Like, you don't need, and we just proved this in earnings season, we don't need 4,000 gold for Newmont, Agnico, et cetera, to do well.
Markets are laser focused on the Fed. A 25 basis point cut is already priced in, but the real question is trajectory. Will Powell map a path toward multiple cuts through 2026? Historically, gold thrives when monetary policy shifts from tightening to easing. Last year, expectations for 4 cuts in 2025 shrank to 2. Now uncertainty dominates. Equity markets, meanwhile, appear stretched, with the S&P 500 heavily weighted toward tech stocks. Some strategists warn the broad market is floating on air, while gold and silver offer a hedge against complacency. Rate decisions in the coming months could define the next leg higher.
I think rate cuts are going to be implemented starting September 17th, no question. However, how big is that, and what is the path for the Fed going forward is really the question investors need to be asking. A 25 basis point cut is already baked into the broad market as well as gold and silver. If we get more than that, that would be bullish. If we get Powell to show us a path to 2026, that would be bullish. Remember, Jesse, last year, around this time, we were all talking 4 rate cuts for 2025. I was on your show, right? We talked about that. Then in December, after the Fed meeting, it became 3 rate cuts, and people were like, "Okay, that's fine." But then it became 2 rate cuts pretty quick, and now we're looking at 1 or 2 between now and the end of the year. So I think that rate cuts obviously are going to be bullish for the broad market, bullish for gold and silver. But I would argue that the broad market is, as Steph Pomboy says, just floating on air. Like the broad market has rallied since March of '09. My message to investors is look at your 401k statement over the last 15 and a half years and ask yourself a tough question, which is, was this my expertise or is this partially luck or all luck, right? I mean, like you have to start taking some money off the table if you're in the NASDAQ and some of these aggressive ETFs. I just cringe when I start to see some of this stuff on client statements, or when we do a phone call together, they mention this stuff and half of their net worth's in some of this stuff and they're 70 years old, right? Like the S&P right now is 45.41% tech as of August 31st. Like you do not want half of your, equity exposure in a 401k, half of that being 25%, right? If you have a 50% weighting in the SPY, in technology, like at that age, right? You have to be smart about it.
Silver is stealing the spotlight with a breakout above $30. Resistance looms near 42, but beyond that, the path points toward 50. And inflation-adjusted targets suggest $68 to $70 may be realistic. Silver's industrial demand from solar to electronics gives it a dual role as both precious and strategic metal. ETFs like SILJ, tracking silver miners, are up nearly 90% this year. History suggests further upside, especially as investors diversify away from overvalued equities. Unlike past cycles, silver's rally is supported not only by safe haven demand, but also by technological shifts in clean energy, amplifying its long-term potential.
On your show last year, even though silver was my largest holding, physical silver and SLV or any of the ETFs out there, we never talked about it breaking 30 ever. We, in fact, said it wouldn't break 30, but we were going to be patient. So we added to silver last year 5 times, from 23 an ounce all the way to 30 when it broke out, right? And then we stopped adding to it. We're just riding it now because it's a 10% weighting in our portfolio. That's a lot. So yeah, I have every incentive to tell you silver's going to 100. I'm not going to say that. I think at 41, you've got some resistance between 42 and 43. We keep knocking on that, and it's sort of just fluctuating right now. We have to get through that level. But honestly, after that, it's all the way to 50. What Don Durrett and I talk about, though, is that 50 is not really the target here. 50 is an old target, given that you have to inflation adjust, and that would get you closer to 68 to 70 an ounce.
Mining stocks are finally catching up. GDX, the heavyweight gold miners ETF, has already tested decade-old highs, while GDXJ, the junior miners ETF, still trades far below its 2011 peak. That gap signals enormous upside. Junior miners, though risky, are gaining liquidity as volumes surge, making exits easier for investors. Silver miners, too, are outperforming, with mid-tier names showing explosive growth. With fewer than 200 producing miners worldwide, scarcity adds value to producers and near-term developers. For those willing to take on volatility, the miners may offer leverage that outpaces bullion itself, creating life-changing opportunities in this bull cycle.
So that's really our target for next year. We think 50 could be achieved by, say, January. And believe me, if the Fed is more dovish, that will be accelerated, right? So silver's looking great. The silver equity ETFs are looking great. SILJ is the equivalent of GDXJ for silver miners, and it includes a lot of the mid tiers like Core, First Majestic, etc. That thing is cranking right now. It's up, I think, 80 or 90% year to date. But what's interesting is that ETF didn't start SILJ until, I believe, January of 2013. So you don't really have, as an investor, a way to look back and see how that thing would have performed in 2010 or 2011, right? But I'm telling you, it's going to be higher than the chart the historic chart is. And so that's what we expect. 23 was the all-time high, I think, on SILJ roughly. And now we're over 20. So we think 23 is an easy target going into next year. If you want, I can go through some of the other ETFs while we're on the subject.
Yeah, please do.
Okay, so GDX is the largest, name out there. It's got over 15 billion US in it. Feneck has run it for many years. What's interesting about GDX is that it already has touched and eclipsed the high, right, from a decade plus ago. Then GDXJ is the really interesting one, which is our second largest holding behind silver. In that we're trading around 86, 87 or something. The all-time high is 179. It's just mind-blowing. So, you have to go back and look at those 15 to 20-year charts and say, wow, this thing still can run. When Don Durrett and I were on stage here at Beaver Creek a day ago, we got, a question about like, is this bull run over? And we're like, no, this is like the third inning maybe of the equity run, because the producers have run, yes. The mid tiers have started to run, yes, but then a lot of the mid tiers still haven't moved that much, and the juniors haven't moved much at all. I mean, it really just depends. The positive thing I'm seeing on the junior side is that the volume is really picking up. Like, I get that question more from high net worth investors more than anything. Like, if I get into this thing, how do I get out? It's a valid question. Some of these stocks trade by appointment. So now we're seeing like 5x, 10x volume on some of these juniors. And we started to see that really since August 1st. August 1st was kind of a key day for Don and I, in that the non-farm payrolls read was bad, but they also revised down the previous 2 months. And that wasn't a small revision. That was 258,000 jobs lost. So like that for me was like the all-in moment. And then Powell came in August 22nd on that Friday and was dovish. And then we put like the rest of our money to work, right? Like we have frictional cash at this point in our portfolio.
We may be in the third inning of a long commodity bull run, not the ninth. For investors, the challenge is balancing opportunity with risk. Broad markets look stretched, retirement accounts are overweight in tech, and passive investors risk being blindsided. Precious metals, especially gold and silver, offer diversification and resilience. Timing matters, but building exposure now may prove decisive as policy, inflation, and geopolitics continue to shift. This isn't about chasing hype, it's about recognizing a rare window. Generational wealth is built in moments like these, and for gold and silver, the window may be wide open, but not forever.
We have a pretty balanced approach between those three buckets that you just named. Near-term production developers are even more interesting. Like, I just had dinner last night with Denarius Metals. It's DNRSF in the States, DMET in Canada. Jesse, there's this new type of financing out there called Life. I don't know if you're familiar with it, but it's kind of detrimental to some of these stocks because it allows the buyer of shares to immediately sell them if they wanted to and keep the warrant, right? That is a common thing in our sector, which we don't do.
Yes.
But it really puts artificial pressure on shares. You saw this with Guanajuato Silver. They just did one for 20 million bucks, much bigger than Denarius is. And that thing was underwater until Don mentioned it on the Market Sniper, and the stock went up 25% in one day. So, I mean, like, this is like go time. You have to figure out a strategy and buy something and buy a basket of something. And that's why we kind of stressed, Jesse, that, Don's services, my services are all very affordable in the context of a bull market, right? Maybe 2 years ago, you couldn't justify it. If you're not aligning yourself with someone like us right now, you're making a huge mistake. This is like lifetime generational opportunity. You're not going to get the same opportunity. I don't think it lasts 10 years like Don. I think it lasts 2 years, like from here. Because if you look at the chart of GDX and J from September of 2022, that was the bottom, right? It wasn't this year. It bottomed there. So like you're looking at already a 3-year run, which a lot of people miss. So yeah, Denarius Metals, they were talking about this at dinner. They were saying, look, we got bombed out. Like we lost, 25% of our market cap because we did one of these financings. And I put out a note to my followers. I have a real-time email service after I got off the phone with the chairman. And I just said, hey guys, like this is artificially low. There's nothing wrong here. We should be putting a position on into something like this that just went into production. Don and I pointed out on stage here as well, there's less than 200 producing miners, and Denarius is one of them. So how is this thing trading at 37 cents as we record this? Like that's the opportunity. That's like worth probably 50 to 60 cents by accident by year end, right? Like that's just we don't always go for the home runs, Jesse. Don's more like the home run guy. He's calculating 5,000 gold and $100 silver into all of his comments when you do hear him talk. And I'm always just looking at the near term, right? I'm looking at 3, 6, 12 months. How can this develop? Because I find that most high net worth clients they don't have patience. They're not going to sit around and wait for 3 years for something to work, especially when tech is doing what it's doing and Bitcoin's doing what it's doing and real estate's doing what it's doing. There's too many opportunities.